Happy to have you all here. We have very special guests from Lee Bank. Our presenter today is David Bruce, and he is the chairman of the board of Lee Bank, which is one of our community banks in the Berkshires. And so you're going to be learning about bank loans and how you get them and why, how they work and everything, which is, we've all talked about startup expenses, working capital, we've thought about budgets. But we've talked about how you might not have enough money in your pocket to start up a business. So one key ingredient to starting up a business is often getting a loan. So this is our chance to learn as much as possible about what that looks like. So we're going to have a presentation, time for questions and answers, and then we're actually going to be able to work with real professional bankers to talk about your businesses. So we have such a small class today that we'll all get to work with people, which is really great. So we're going to take a lot of time at the end of the class to do that. So I think at the end of class we'll also talk a little bit about what we're going to be doing next week and until the end of the course, which is coming up really quickly. But right now I'm going to turn it over to Mr. Bruce.
Thanks, Alice.
Thank you.
So, has anybody heard of Lee Bank before? Everybody? Yeah. Anybody got accounts at Lee Bank? Maybe they do business with Lee Bank. Great. So, Lee Bank has been around for a long time, since 1852. So, our sole business is located here in Berkshire County, and I want to kind of have this presentation be more questions that you may have and answers that we can give than me just standing up here and lecturing, because I can provide a lot of information, but I don't want to drone on like a typical presenter. So I thought we'd start off with just some questions and try to get an understanding from you folks as far as what's your understanding of what a bank like Lee Bank does.
Michaela, you have an account with Lee Bank, so what do you use Lee Bank for?
Depositing, texting work.
Okay. So the bank takes that and then you can have that available at any time, checks or debit cards or whatever. Do you have a debit card?
Yes.
Okay. All right. Sure.
Gives out loans,
Right. For what, do you think?
businesses.
Businesses?
Houses.
Houses?
Cars.
Cars? Anything else? So if this is a business class, what kind of a loan do you think that a business would need? What would they need money for?
Everything.
Everything, okay. All right, well, we can get to that. So, sure, a bank basically takes deposits from folks like yourselves and uses that to make loans in the local community. So I'd like to kind of demonstrate a little bit how that works. So does anybody have any money today that they would like to deposit into our bank right now? All right, so we've got one person that wants to hold on to their money. So now the bank now has $2,000, right? So if this was our only business, we'd be $2,000 to the good. So we already answered it. What can we do with this what can the bank do with the $2,000? Like lend for a house or a business or a car. Now, we've only got $2,000 to start, so maybe someone in the room might need a car.
I do.
All right. And what do you need your car for?
To drive my product all over Berkshire County.
Great. So how much money do you need?
$1,500.
$1,500. Can you make it $1,600?
$1,600.
Right. Okay, so I'm going to give you $1,600, but you have to promise to pay me $100 a month to pay that loan back. Okay. Just like I told those people that put money in the bank that I'm going to give them $5 a month for their $500, I'm going to have you give me $100 every month.
Fair enough.
Until you pay back that $1,500, okay?
Or I could move to Mexico.
You could. But we'll get into that what that will mean for your credit later. Okay, so now we've gone by in a little time, and now it's the first of the month, and now she's got to fulfill her promise to the bank. And so she's going to begin repaying that loan. So I've got my first $100 payment. She has perfect credit right now because she's made her first payment on time. So now I've got this $100, and I've got to do some things with it as a business. So the first thing I'm going to do is I'm going to fulfill my obligation to those that put money into the bank. You gave me $100 or $500, right? So there's your interest payment, and there's your interest payment.
I got 2 of them.
I thought I was short. Thank you. You gave me $500, and you gave me $500. And I'm sorry, but yours is still only worth $500.
But it's under his pillow.
But it's under his pillow, right? So now I've gotten the $100, and I've given out $20, right? So I've got $80 left, but there's something I've got to do because our trusty bookkeeper back here has been keeping the records of the bank. So because he's an employee, I've got to pay him, right? So there goes some money out the door. And that happens, we've got to pay for a building and other things. And at the end of the day, the difference between the money that she paid me for that loan and the money that I gave to you folks and the money I pay for the expenses ends up being the bank's profit. And so the bank basically just collects money from all members of the community so that they can then use that money to lend it back out to those that are in need, like for a car loan or a business loan or a home. So does that kind of make sense about how a bank may operate?
So you mean a bank is a business?
Sure is.
It's not just a bank?
It's not just a bank. Sure.
Won't there be interest on the phone that she'd have to pay?
Right, well, the interest was included in part of the $100 she gave me.
Oh,
Okay.
So ultimately, I'm not gonna pay you the $1,600 that you lent me, I'm gonna pay you $2,000?
Yeah, probably something like that. And ultimately, I'm not going to pay them back the $500. I'm going to pay them back $5 every month until they take the money back out of the bank.
But why is that a good deal for me? Like, yeah, I get the money when I need it,
Right.
but I'm still paying more than it's actually worth. Or at least that's how it seems to me.
You're paying more than what the car is actually worth, right?
But also the money has now magically become more than it's worth. Become valued at more than it actually is. So how is that a good deal for me?
The money is actually valued for more than what it is.
Like,
I think she said she's paying more, she has 1,600, she's paying more than that, so. that's
yeah,
what she
so,
meant, yeah.
Right.
like how, all of a sudden, this isn't a $500 bill, this is a $700 bill, but it still says $500.
Right.
But you think it's $700.
Well, it's,
Does that make sense?
Right, because you're basically renting that money from me,
Okay.
right? And when someone rents something from someone, there's a price to pay. Now, if you rent an apartment, then you have to pay $500 a month in rent, and you never see that money again.
Yeah.
So it's kind of the same thing. I, as the bank, am renting money from those folks that gave me that $500 to begin with, so I've got to pay for that. And you're renting now the money from me, and you have to pay me rent on that money. So it's both sides of that equation.
Okay.
But I could answer the question very technically, and
Well, the reason why it's a good deal for you is because you get to go in your car and drive your products around Berkshire County and make money, which you wouldn't be able to do if you didn't borrow the money.
right, so you're paying for the convenience of being able to get that money right then.
Yeah.
even though you didn't have that money in your pocket at the time.
Yeah, so you
But I
could
could have been smart and I could have kept it under my pillow and then I would have had it.
Not everybody's that smart.
And it would have
But
taken a long time.
Now he's got $500 under his
Too.
pillow.
Yeah, and if you didn't have it in the first place, you can't keep it under your pillow.
This is true.
Right.
You have to go out and make that money.
So that's what Keith Gerard talks about. He talks about leveraging money, like so you can use what you have to make it worth more. I mean, he talks about using it as a tool.
Right.
So borrowing it when you need it is using it as a tool, even
Right.
if you're gonna have to pay it back later. But it allows you to make the money from your business, because if you didn't have the car, you couldn't drive it around.
Because if you're, basically it's costing you $400 to have 16 months of being able to make money,
Right.
right?
Right.
So it's gonna take you 16 months to pay it back, but you'll have those 16 months to make money, or you can sit at home and make no money.
So we're kind of talking about this third bullet point here is how does it help individuals and businesses? Well, it helps the individuals because now they've made their money grow,
Right.
and it helps you as a business because now you can deliver your product. But there's a cost to being able to deliver that product if you don't have the cash yourself to buy that car.
Right.
So if everybody had cash to buy a house or fund a business or buy a car, then nobody would need to borrow money from the bank, but that's just not true. Sure.
So if we're giving you our money, how do we know that we're gonna be getting it back?
That's a very good question.
You hope,
What's that?
you hope.
Well, there are a lot of safeguards. And one of them is that the bank is really never allowed to lend out more money than what it's taken in from depositors, so to speak. So, and that money's being repaid all the time. And so if you come in the next day, I'm gonna fulfill that promise. But there's another aspect because there's a company called the Federal Deposit Insurance Corporation, and it's FDIC for short, and they insure your money that's in the bank in case anything ever happened to a bank that they couldn't repay that. So if that would happen, then the FDIC would come in and they'd make good on that. And we, as a bank, we pay insurance premiums to the FDIC, and all the 7,000 banks around the country are a member of the FDIC. And so there's this huge fund of money sitting in Washington at the FDIC that's there just for that purpose, that to guarantee that if you put money in the bank, then you'll get it back. Yep.
If I wanted to have a business that was a bank, how would I start that?
How would you start a bank?
Yeah.
Well, you would need a lot of money, first of all. Nowadays, it costs about $25 million to start a bank on day one. And you would have to, first of all, identify a community that you thought had, let's say, unmet banking needs by those other banks that are already in the community. So you could go into that community and provide a service, a banking service that might not be done by other banks. And then you would have to make applications to regulators. The FDIC that I mentioned is a regulator. So you'd have to ask the FDIC for permission to open a bank. You would have to ask probably the state of Massachusetts for permission to open a bank. And you would have to do a lot of the same things that are being done in this class in terms of a business plan. You have to have a strategy. You have to identify management. You have to identify all the resources that you're going to need. You have to have a budget. You have to have staffing. And you have to prove expertise in that particular, in banking in order to do that. So it does happen. Yep.
Where did the number 25 million come from? Is that like fines or is that capital?
Capital.
Oh, yeah.
Right, that would be the amount of, you would have to get investors to invest in this idea of starting a bank and have them come to, how many number it took to get $25 million, but that's pretty much the number these days. 20 years ago, you could start a bank with $4 or $5 million. But because times have changed a lot, then the regulators now require a lot more money up front in terms of capital in order to start a bank. It's a good question, though. All right, anything else on how banks work and so forth? So, here we go again.
Oh, I think you can,
Oh, I gotta go to full size.
if you go down rather than next, yeah.
Okay, so we're talking about business opportunities, an opportunity to start a new business. So from everything you've learned here, what would be your definition of a small business loan?
A loan for small businesses?
Okay, So if you have a small business that you're gonna, what's the business that you're gonna start? A food truck, ah. All right, so what would you need money for to start a food truck? A food truck, right. What else do you think you would need money for?
Like kitchen supplies.
Kitchen supplies, sure. Food, okay. So, there you go. That's what a small business loan would be for. Anybody else, what's your business?
Restaurant.
A restaurant, okay. So, what would you need money for to start a restaurant?
Food.
Food, anything else?
Supplies.
Supplies,
The building, rent.
Yep. okay,
Renovations.
yeah, okay, good. Any other interesting idea? I know they're all interesting, but Okay.
I'm starting a candle making company.
a candle making company. So you need wax and wicks, molds.
And maybe a wax melting tank. I haven't figured out if that's like, you know, if it's gonna cost a lot to melt wax on my stove or plug it in.
Well, that might be phase 2.
Yeah, no
Yeah.
kidding.
Okay.
Crock pots? Oh, oh yes.
What was that idea, crock pot?
Yeah.
I love the
Yes. Stationary.
All right, so in this business of providing services to the local community and especially small business loans, what do you think the bank's objectives are? And first and foremost, we want to see you as a borrower and a business person in the community to be successful. And so we spend a lot of time with borrowers trying to assess like their business plans and so forth, because we don't want to necessarily foster failure, if you want. We want to really help you create success. And so that's very, very important. And also, as we saw with the repayment of that loan on time, we obviously want to see our loans repaid. We don't want to lend out $1,500 and then have her go to Mexico because she just bought her plane ticket and she got a condo for a couple of weeks or whatever. And now the $1,500 is gone, and now we got to come up with another way in order to pay you guys your interest. Yeah.
We won't be able to have a loan for a trip. That's not people.
Sometimes. Sure.
It couldn't be out of the country though.
You say it's called a credit card, right?
Well, as we get into the presentation, we're going to talk about some of the criteria for granting a loan. And so if we feel that you meet all those criteria, and one of the things we're going to talk about lending is character. So if we think you're high character and you're going to go out of the country and we think you're going to come back, then we may be all right. So we obviously want to see the loans repaid, but we also, like the Berkshires and kind of the purpose of this class, is we want to help the local economy thrive. So if there weren't banks out in the community that were lending money to small businesses, then they couldn't create these products and services that other members of the community would then buy, and it just kind of helps the community. I know the focus of this class is what products and services can we sell in Berkshire County that we're currently importing from other parts of the country that we could create here. And so that's all part of helping the local economy thrive, and the banks play a huge part in that aspect of our local economy, because they're what they call an engine of the local economy, is the ability to provide this mechanism to transfer money between folks that have it and want to put it in the bank and those that need it because they want to buy a house or a car or start a new business. And I think even more important, and you guys can start this process today, is to build a solid relationship with our borrowers. And you can start this process today because you've got an opportunity to meet with bankers who actually do small business loans. And we think that as a community bank that's been around in this community for a long time, this is what really makes us as a bank, is establishing relationships with customers. And so that's very important, yeah.
Are you more inclined to lend to people who have an account with you already?
Not necessarily. That's not part of the underwriting criteria. It helps, or we ask that if we're going to lend you money, that you start a deposit relationship with us as well. So if you're gonna start your candle business and we're gonna lend you money for 10 crock pots, and you're gonna make your candles and sell those, we want you to deposit those proceeds into our bank and write your checks off that as well.
Why?
Because that then helps us lend more money out into the community. Because if you're not putting that money back in the bank, then we can't then accumulate funds to lend to other people. So it's like this constant flow of money coming in and money going out. And that's why, go ahead.
If you were you more likely to give a loan to someone that is with Lee Bank? If like there was someone that was going in the Lee Bank?
Well, if we have an experience with that person, that helps, but it's not necessarily more likely that we would grant a loan to that person. I mean, we could have a person that maybe has had a long relationship with another bank, and this happens frequently, and they say, you know, the other bank really ticked me off, and I can't do business with them anymore. Would you guys be interested in doing business with us? And we say, sure. So that's, you know, doing business with us currently isn't a criteria. These are all great questions, by the way. So let's start talking about what are the bank's underwriting requirements. So if you're going to come to one of these loan officers here with your business plan and ask us to help fund your business, how are we going to take a look at that? So one of the first things that we look at is what are the sources that you have to repay us? Because remember, one of the objectives that we said was that we want you to repay the loan. So we have to look at where the money is going to come from. And we have a thing called primary, secondary, and tertiary. So basically, what's the first source of repayment? What's the second source of repayment? What's the third source of repayment? Because if the first one doesn't come through, what else can we fall back on? And if the second one doesn't come through, what's the third thing that we can fall back on? So the first one is, as you create your business and you've got sales going on and you're making a profit, that's called cash flow. And so the money, the net amount of money that's coming in and going out of your business, so the revenue that you get from selling your product as compared to the expenses of your raw materials and your labor and distribution and those type of things, the net effect of that is the cash flow. And so we want to make sure that your business has adequate cash flow in order to repay the loan. Now, in most cases, we also on loans require that someone also guarantee to the bank that that loan is going to get repaid. And in most cases, that is the individual that is the owner of the business. And so a lot of people say, well, why do you need my personal guarantee? And we have a basic premise that if you don't believe in your business enough that you're going to offer your personal guarantee that if the business can't make the payments, then you will personally, then we're a little bit iffy about the whole business proposition, because that tells us that you don't really believe in the business either. And so that's a very important consideration. And then the last one, and this is the one that we absolutely hate to do, is that we would take your assets back from you. So if the cash flow of the business, the candle business, wasn't sufficient to make those payments on the loans, then we would go say, okay, what are the resources, because the business really isn't cutting it right now, what are the resources do you have to pay back the loan? And they say, well, we don't have any. Then we say, well, you've left us no other recourse than to give us those crock pots back. And then we'll try to sell them and pay off the loan. Or we'll ask the business owner, okay, you need to sell off your assets as the final straw in order to pay back the loan. So does everyone understand that? What's yep?
Is that true even if you're an LLC?
Doesn't matter.
So your personal assets as well?
Well, the personal assets would be on the guarantee. That's correct. That could be. And it depends on what other assets that you have.
Sometimes do people have like the option of going to the liquidation of assets before the guarantor?
Sure. Yeah. And you're in control of your business. And if you say, this just isn't working out, bank, I'm going to sell off my assets. I'll give you all the money that I collect from those assets, to help repay the loan. And then whatever left over is I'll make every effort to pay it out of my personal resources. Sure. This is from the bank's point of view, but your point of view could be different. Yep.
Would there be a way that, like, if I had, like, a loan, and then I didn't have, like, the amount to pay right then, would I be able to make a deal with you to make it where, like, this week I would pay a little bit less, but the next, or well, this month I pay a little bit less, than the next month I pay the full plus what I miss?
Let me go back to this here. Oh, I skipped over one. Sorry about that. I'll get back to that. But remember we talked about building a solid relationship with borrowers? That's one of the bank's objectives. And so one of the things I'm going to talk about in a little bit is that having that constant communication between you as the business person and the borrower and the bankers, so that we always know where you're at. And we try to work really, really hard with our borrowers that way. Go ahead.
So what's to stop me from going to another bank and asking for money to pay this loan out, but saying that for something else, but then using that money to pay this? And then just like a constant cycle of like going and asking.
Well, it's like that's never happened before. That happens. And what's going to stop you is the other bank taking a look at your situation and either saying, yeah, we could help you out with that, or saying, wait a minute, no, you're getting in too deep here. So it's really the other bank. Other than sometimes on certain loans, we might put conditions on that loan that you can't borrow money from other banks unless you have our permission. That could also be it, but that's really getting technical. It is with especially new businesses, we look for what are called credit enhancements that gives the bank added levels of protection in this period when your business is starting up. And I mean, starting up a business is tough, and waiting for all the cash flow to develop and so forth. So we a lot of times will look for what we call a guarantee, other than from the personal guarantee, from a federal government agency that's called the Small Business Administration. And as a potential small business owner, that's a very important federal agency to just know in the back of your mind, because they provide guarantees to the bank that helps them make loans to small businesses that they might not otherwise make without that federal guarantee. And so they tell us, the bank, you make the loan, we think the borrower has a good chance of repaying the loan. But if they don't, then it actually becomes like a fourth level of repayment here, if it got to that. So it's an inducement for us to make loans to small businesses where, it might be a little bit iffy and that sort of thing. And then sometimes additional collateral sources, because if you're opening a small business and you're going to give your business assets as collateral for the loan, that might not quite be enough. So if you own a home, we might say, well, we want you to pledge your home as part of the collateral, and we'll get into collateral a little bit more. But I apologize, trying to run this thing without the up and down. I missed the most important. And we used to call them the 5 C's of credit because everything started with a C, obviously. But lately, we've changed that to 6 C's because the 5 initially were character, capital, capacity, collateral, conditions. And then we actually credit used to be part of character, but now we break it out. But let me explain a little bit about what these are, because we take into account these 6 factors when we're assessing whether we're going to grant a loan to either a person for a car loan or a home or a vacation loan or a small business. So, what's your name?
Ethan.
Ethan, if we have a really good feeling about all these 6 C's here, and I'll explain each one in detail, then we'd be glad to give you a loan to go to Europe or wherever it was. So, it might be a good idea if you're taking notes to write these down. But now that I've already done that slide, let me go and we'll first talk about credit. So what do we know? Has anybody ever heard of a credit score? You see them on TV all the time, right? We can help with your credit score. So how would you describe credit? What a credit history?
It's like, it's sort of like an evaluation of what you've done in your life and your ability to like pay back certain loans with other banks and other stuff.
Sure.
And then it helps make banks make decisions on whether it's like a good idea for them to give you a loan also.
Very good. So it's your history of paying your obligations in a timely manner. And, you know, a clean credit report, you know, you paid your car loan on time, or your vacation loan on time, or your credit card every month. And I know a lot of you in the room are younger and haven't had the opportunity to establish a credit, but we're going to talk about some of the steps that you can take to think about beginning to establish credit. So yeah, it's your history of meeting your obligations in a timely manner. Now, if you're renting and you're paying rent to your landlord, that doesn't show up on a credit report, but the bank may take that into account when they're trying to decide whether to grant, let's say, a mortgage loan, because you don't have a history of paying any other mortgage. So we may say, well, get us a statement from your landlord saying that you paid your rent on time for the last 2 years or whatever it was. Come for a banking lesson, Mark.
There's some chairs over there.
Okay.
So secondly, and here's what I think is good. If you have a good credit history, then make sure you maintain it in really good order. Don't make late payments. If you are having a struggle, go and talk to your lender and see what kind of a situation you can work out to maintain that credit history in good shape. If you have a not so good credit history, repair it. And I hear ads all the time, and it drives me crazy about these credit repair organizations. You know, you see it on the TV or you hear it on the radio. If you've got bad credit, come to us and we'll help you fix it. Well, that's probably the worst way, because they're just going to charge you a lot of money in order to try to do that. I know personally, because my brother who fell into that trap and got himself into a mess. So what are if you have bad credit, you can repair it by making payments on a more timely manner. It might take a while. It might take, what, 1 or 2 years to rehabilitate credit? Yeah. You know, a lot of people have had credit that they never repaid. And so it ends up being what the bank calls a charge-off. Yeah.
Well, it would be a good credit score.
What's a bad credit score? 600? 650?
Below 600.
Yes, below 660.
Yeah.
650,
And a really good credit score is 800. There's so many things that affect credit scores. You know, these credit agencies have these mathematical formulas that figure it out, and I don't think we bankers even understand it. But,
So, in that, like, it's overall it's kind of a far score, but it's really not. It's only to how much would it change if I were to miss like a mortgage?
130-day late?
Yeah, if you have several pieces of credit and you're late 30 days, it's not gonna hurt you as much as if you pay 60 days late. That's gonna really do some damage. But one time late is not gonna destroy your credit. You usually can talk to the loan officer, why was late? You know, you must have just missed the payment, forgot to pay.
And a lot of credit bureaus allow you as a consumer to send them a letter giving an explanation of why that credit happened. So if someone pulls a credit because you want to borrow for that vacation to Europe, the bank's going to pull a credit report on you, and you're going to say you were 30 days late. Oh, but here's the explanation. Let's talk to him about that.
Doesn't your utilization rate have a lot to do with your credit score as well?
Yeah.
I mean, if you've got 10,000 available and you're using 9,000, it's a problem.
Yeah.
I've heard about these things.
Well, what's even worse if you have like 3 or 4 credit cards and they have $10,000 each and haven't borrowed anything?
Right.
Because then the credit bureau is going to say, well, wait a minute, that person could go into debt to the tune of $40,000 really quickly.
Right.
And then their credit could
Yeah,
kind of go.
that ratio between debt.
Yeah, yeah,
Credit. That's the
it's
right
very
middle.
hard to figure out,
Yeah.
but.
And the credit score is not an end-all, be-all, because
Right.
we look at, sometimes I don't even look at the credit score, I
Yeah.
just look at the credit itself,
Right.
and I kind of, when I look at the credit score, it's like, wow,
Oh,
it's
that's-
either a lot higher or a lot lower than
What do you think,
whatever I was
right?
expecting, so.
Now,
to
yeah,
dive into it.
Yeah.
Can you only get credit by borrowing
yes,
and repaying?
right.
So like,
Double X.
So here's
Yeah.
the way to do
this
it.
doesn't make any sense to me.
No, you're right, because a no credit score is almost worse than a bad one, because now there's no history.
Right.
So one of the best ways to begin to establish a credit score is you could maybe ask your parents for $500 to put into a account at Lee Bank. And then Lee Bank would then lend you that $500 back. But we would require that you make monthly payments. And so let's say you pay that loan back in a year. Now you've got a credit history that is unblemished. And so you started to build it. Now that is a history that can be built on, because now you might be ready for a car loan. Oh yeah, great, you paid that loan back with no problem. So let's give you a car loan. So, and I would really encourage you to start to build a really good credit history early. It doesn't mean you have to go out and get a credit card and spend money, because a credit card company's probably not going to give you one yet without a credit history. But there are ways that you can establish a credit history pretty easily. A lot of banks wouldn't do that type of thing, but Lee Bank does. Ethan.
I have two things. So what would be like a perfect credit score if you just like the highest you could have?
800 something? Have you ever seen one in the nine? I don't think, never in the 900s, right?
850 is the top.
850 is the tops, I guess. Okay.
So then my question is, like, in school it starts at like 0, and then depending on what your first thing is, it could go up to whatever you got. Does your credit score start at 0, or does it start at 850?
It's in between.
Yeah.
In
To get to
between?
850, you have to have some available credit, like you're talking about line of credit, some long-term debt. Over time, it builds and gets better. If you've only had a loan for 3 months, it's not going to throw you an 850, it's not going to throw you a 0. It's going to be in the 7 range, 7.25.
It would probably take that whole year for the credit history to establish itself to the point that you could get up into the 700s.
It's probably more important to worry about like the principles of it, like what we were just talking about, rather than the actual score. It's more important just to know what it takes to have good credit history and how to build credit.
Some people start with the credit score with a student loan, paying back a student loan.
Mhm.
Or getting a car, you have a parent co-sign it for it. But that's usually what we see first.
Listen, when you folks go to college, I can almost guarantee that at that college, the first day that you're there for orientation or whatever, there's going to be a big credit card company, Capital One. There's probably going to be Samuel L. Jackson sitting at the table wanting to take your credit card application. Because that's it's just what they do. And sometimes it's good, sometimes it's not so good. But start before then. Yep.
I just had a question about whether that credit history is tied to the individual lendee or the business. So can you have two
It's tied to
separate-
the individual, not the business.
Okay.
Right. The credit companies don't report credit scores on businesses. There is a service called Dun & Bradstreet that tries to collect credit on businesses, but it's very unreliable and we don't even use it. So it's on the individual. So the second C that we talked about is character. And so, this is, are you a good risk? Just from us sitting down and talking to you. And so we want to make sure that you're honest, that you have integrity, that you're not going to take our money and go to Mexico or tell us you're going to start a candle company and start, doing something illegal, whatever that may be. And it's amazing sometimes the tools that we have to help us judge character, because a lot of times we have people that come to borrow from us that we don't even know. And we had an individual come to us, and they had like a wholesaling company, and they wanted to establish a business loan to help fund their inventory. And we didn't know them. We Googled them, and come to find out they had been convicted of securities fraud. And that doesn't show up on a credit report all the time. And there was another case, you had one too, didn't you?
David did.
Dave?
Yeah, an individual who had been not convicted, but charged with murder.
Murder.
Yeah. So that was interesting.
So if he's convicted, what's his ability to repay the loan?
That's a great question. Yeah, it was pretty slim.
Yeah.
So you focus on,
Right.
it's not necessarily a murder charge, but.
Assessment's charged but not yet exonerated?
He was indicted, right?
Yeah, it wasn't, was given a suspended sentence, so they'd served some time, and that was, I guess, sufficient based on what they actually
Reduced
found.
charges, reduced charges.
So how do you find out these things?
Well, Google, Facebook, LinkedIn. I mean, hey, listen, you all know what stupid things people put on Facebook, right? Ethan?
Says that I took a loan and I ended up going like to jail.
Yeah.
Then would I also get an even larger sentence for not paying?
I don't think those two would be linked. But we'd be looking for you when you get out. Yep, go ahead.
This might be a silly question.
There are no silly questions.
Okay, so I get that murder is illegal. I get that. But, and like, it doesn't have to be murder, but with the whole murder thing, like, that doesn't necessarily mean that you're gonna like not pay like a loan. So, I'm
No,
not
you're
saying
right,
like
you're right.
murder
You're right.
in particular, but like in general, like, why, if, like, sure you do something illegal, but like I could like, smoke a cigarette underage, like, because I'm like 17 and I smoke a cigarette, but that doesn't mean that I'm going to go out and like murder someone.
Right.
Like with the two different levels.
Well, I get, we're using kind of extreme examples here, but what we're really trying to do is we're trying to identify your level of integrity and your honesty and how much we can rely on you to pay us back. And we're looking for any information that can help us make that decision, because we don't know you, and we've got to get to know you.
So that's one reason why it is nice to have a start a banking relationship early, so then they will know you better.
Sure.
So do you try not to give out loans to like people who do have like a history of like being incarcerated? Like,
Well, I guess histories can be rehabilitated just like credit can be. And so I wouldn't say absolutely no. It depends on what they've done since that. Listen, we all make mistakes, right? And sometimes it takes longer to recover from those mistakes than other mistakes.
And what about the capability of like paying back the loan? Like, this is another extreme example.
Yeah.
Like a homeless man had like $1 million idea and he needed $1 million. Like, if he were confident enough that like he thought that he could make that kind of money with the idea, what would the chances be like versus his income?
I'm gonna answer that question, but I'm gonna answer it by going a little bit further through these C's, okay? I don't want to get too far ahead of ourselves, but you will get the answer to that question. Yep.
I don't know if that exactly has to do with like character, but I can't remember his name, but it was when we were talking about money.
He's sure.
Yeah, we were talking about like the not dead zone, but kind of like the point before you start making money.
Mm-hmm.
Like, would that be factored into like our loan?
Sure, because your cash flow forecast, you talked about that, right?
Yes, a little bit.
A little bit, is going to show what those dead zones are. So any new business is going to have that initial dead zone. So we do take that into account.
Would that affect like how much we'd have to pay each month? Or no?
Could be, because sometimes we'll structure the loan so that you pay us back less during the early period, and when the business is just starting, and pay back larger amounts after the business has matured a little bit.
I think we should come back to that when, we could actually talk about what a loan looks like and,
Yep.
but let's get through these a little bit later.
Can I just ask one quick question?
Sure.
To do with the character. If, you know, a lot of kids nowadays are being warned to be very careful about what they post on Facebook and social media. And if certain kids are staying away from those kind of things, starting to stay away from those kinds of things, or adults for that matter, what, do you still use the old-fashioned modes if somebody doesn't show up very much?
Oh yeah, yeah, it's not going to hurt a person.
You still so you still would use it.
The primary thing is going to be the credit,
Yeah.
okay? And us sitting down across from one another, because you know a lot is going to show on the credit report, and a lot is going to come out in the face-to-face meeting.
And so, but also like letters of recommendation,
Sure.
that kind of things
Mhm.
also.
Yeah, anything that can support your level of character is important.
So if one of these wanted to come in for a loan application, it might still be a good idea to bring letters of
Sure.
recommendation.
Yeah, yeah. So, I'm already at your question about the homeless millionaire idea. Because one of the things that is very, very important in any business is that there is funds invested before the bank lends money. And it's traditionally called the capital that is injected in the business. And I know next week Eric Broom is going to be speaking, and he's going to talk about, I think, this idea of the initial capital that's injected. Because I don't know if anybody's ever heard of the term venture capitalists. And venture capitalists, they take their own money and they make big bets. Shark Tank, anybody familiar with Shark Tank? All right, so they're venture capitalists. And so they're listening to these wild ideas, and it could be the homeless man with $1 million that gets on Shark Tank, and one of the people on there says, this is the best idea I've ever heard. I'll give you $500,000 toward this. And then the other person says, no, I'll give you $700,000. They make a deal. But they expect a lot more back in terms of what they've invested than the bank is. So the bank is not, like I said, in the venture capital business. And we think it's very, very important for you as the business person to have what we call skin in the game, meaning you've got some of your own money or an investor's money at risk here, as well as the bank's money. So there are ways to do that. And oftentimes these investors work hand in hand with the banks in order to make it happen. As a matter of fact, there's a fund here in Berkshire County that was set up to help businesses that maybe don't necessarily qualify for traditional bank loans.
So with an investor, like with you, I'd have to pay extra, and like I'd have to pay back my loan.
Mm-hmm.
But with an investor, if I didn't have the chance to, like the business shut down or anything that ever happened, I didn't make that much money, they couldn't do anything about it.
Typically, if there's a capital investment like that someone from the outside and the business goes under, they lose their money. That's the risk that they're willing to take. Because they don't, we'll get the collateral here in a minute, but they don't have anything to fall back on. So it's risk reward. They take high risk because they're investing their money in a startup company to a homeless guy that has $1 million idea. And they're willing to risk it all. But they're expecting a big payoff if it does come through.
So, but it'd be their losses, they
Yeah.
couldn't do anything to
Right.
be about it. They
Right.
couldn't expect their money.
Typically not.
Okay.
Okay. So like I said, we're really looking for some, your financing to be not all bank debt. We expect some money from either yourself or investors or whatever. So the next C is capacity. And remember we talked about the primary source of repayment being the cash flow of the business? And that's what we're talking about here. It's very simple. Do you have the financial capacity to pay back the loan? And in a business, we want to make sure that there's sufficient cash flow. Now, there might not be sufficient cash flow in the beginning of the business, like you mentioned, Ethan, but based on your projections, might show much greater cash flow. So those projections and your budgets for a new business are very, very important for the bank to determine your capacity to pay back the loan. It's not your willingness to pay back the loan like credit and character are. It's do the numbers of the business support the repayment of the loan. And we have formulas that we go through that we don't necessarily have to get into. But when we talk about the capacity, we want to see those forecasts that show that the business is going to be able to repay the loan from the business itself.
So in other words, do you have a good business plan and so to go to actually what you guys are working on, in the financial section, I want you to have little paragraphs under the startup and the budget, but I also want to have the details about how did you get to those numbers. So for example, he said, I need 3,500 to start this business. But he only said, I need 3,500. He didn't say, for this and this and this. And then he said, I'm gonna make this much money in a year. But he didn't say, I'm gonna make that much money because I'm gonna sell 500,000 pens. So I want you to detail it as much as possible because a lender would want to know, how did you get to that number? Is it really based on reality or are you just making stuff up? So try to be as detailed as possible. You can have paragraphs, but then have attachments that have it broken down.
Yep.
With a loan, like say I asked for $150,000, would we make a deal where I get less of a loan or something like that, or would you the first choice be the $150,000?
Well, the first choice is always what your business needs are. And there's kind of a trap that you can fall into that if you've done your financial projections and you've told us that you need $150,000 in order to fund this business, and we say, because of this, this, and this, we can only lend you $100,000, that's a recipe for failure. And remember we talked early on that one of the bank's objectives is for you to be successful. And us under-lending to you, if you will, is a recipe for you to be not successful. And so we tend to be kind of careful about that, to make sure that your needs are matched with what the bank can do. And what the bank can do is really dependent on all these C's that we've been talking about.
I just have one more thing. Say that I only needed $125,000 of what I asked for. Would you also give me that extra $25,000 for extra costs?
Very likely. Because most businesses want to build in a little bit of a cushion. Because things rarely go according to plan. And so we really like to see an extra cushion. A lot of times we like to see that from the previous C that we talked about, capital, that there's plenty of cash around to help in that initial period. So who can give me some ideas of what collateral is? A car is collateral. A house is collateral. The food truck is collateral. The kitchen equipment is collateral.
Is it only physical stuff? Not my bank account that's sitting there that has however much money in it?
A bank account could be collateral.
Okay. Investments?
Could be, yeah. So Nick's business plan is to build pens. So he needs ink and wood and things like that. Would those things be collateral?
Well, I feel like they could be, but a bank wouldn't necessarily want them. Because
That's a very good answer. That's a banker's answer.
It is collateral.
Yeah.
It'd be more of a hassle, I feel like, for a bank to have to resell all those smaller individual parts than it would be just say you need to pay this back over.
Right. So, for example, a house is really good collateral, all right? So if your house was, if you were buying a house, let's say you were for $100,000, or had a house that was $100,000, we would lend you $80,000 against that house. So we'd lend you a lot of money against that house. But if you've got collateral like ink and, you know, wood things, we might only lend you, if you've got $100,000 of that, we might only lend you $20,000 against that. So the amount that we'll lend against any specific type of collateral depends on that collateral.
You say against, what do you mean by that?
Okay. Remember the third source of repayment that we had was the liquidation of collateral? So when we take that house or equipment as collateral, what we're doing is we're lending money with that as that third source of repayment if we have to go against it. And that's what we mean by against. Okay?
So it's like something that they could take if they don't get the payment back for the loan.
Oh.
So it's like weighing it, that's why it's against, yeah.
So when we lend to individuals for houses, for cars, or to businesses, we, in most cases, look for some kind of collateral so that if we have to go to that third source of repayment, then we can do that. Because remember, one of our objectives is to get the loan repaid. And you know, we could spend here all day talking about different types of business collateral, but the food truck would be a good example, the restaurant equipment, I mean, those are all things that we probably have lent against. And then the last one here is conditions. And this is all of kind of like the outside factors that might affect your business. And these are all the factors that really should be addressed in your business plan. I looked at one real quick, and one of the issues was, well, who are the competitors for this product? So as I was driving down here, I was thinking, well, how am I going to explain conditions? And I have no idea why, but I'll go back to my brother again, whose cat is sick. And it's just because it was on my mind. And let's say your business plan was that you wanted to have a market for organic cat food to feed to the cat population in Berkshire County. And you're going to use, you know, products that were indigenous to Berkshire County to create this cat food. But you do your research and you find out that there are already 3 other companies that are providing organic cat food here in Berkshire County. Well, that would be a condition that we would want to look at. If you were, you know, let's say the candle business, and you're going to make these beautiful homemade hand-dipped candles, and you haven't properly identified who those competitors are, that you're trying to sell against, and you've got to convince the bank that you've looked at these competitors, and in this instance, this is why your product is going to sell better than their product. You have something very unique about your product that is going to make it very attractive to the marketplace. And it's almost like when we talked about starting a bank. What are the unique aspects of that new bank that you want to start that is not being provided by the other banks that are in the market? So I like to talk about in terms of market need, unmet needs, or a significant competitive advantage that separates your product from the competition. And for example, in banks, you know, one of our significant competitive advantages are the 3 guys that are sitting up back, because they're really, really good. I guess one of them left. They're really, really good at identifying what your needs are as a borrower and tailoring solutions to meet what your individual needs are. Versus some banks, they use like a cookie cutter approach, where it's kind of one size fits all, and they don't try to create individual solutions. So really, really think about what is the uniqueness of your product and why is it going to sell against those the competitors.
So in your business plan worksheet that you guys are using to write your business plans, that's in the competition section. So what you wanna be saying is, why are you different from your competition? Who are your competitors, and how are you gonna be better than them, or sell better, sell more? But also, like, could trends be a part of that
Sure.
too?
Yeah.
For conditions, so like,
Mhm.
maybe
Economic trends.
organic cat food is the hottest trend right now, and you're gonna get in front of it, and you're gonna sell organic cat food before anybody else.
Right.
Because it's been shown that it's really hot in New York City and it's coming to the Berkshires. So that could be something that you'd wanna include as well.
This isn't really about like the like competition and that stuff, it's just thinking of conditions.
Mhm.
You're the chairman of the board of Lee Bank. Did you go to school at all for that?
Well, I got my bachelor's degree in management finance.
Okay,
Yeah. But I learned banking on the job.
okay.
All right. So does that, anybody have any other questions on like conditions? So then we kind of put it all together, and we've kind of woven this in and out of our discussion today, that the first thing, make sure you have a well thought out, well presented business plan, and that is really, really critical to establishing a first impression with your banker. And I know that, especially Bruce Marzotto, who's been lending in Berkshire County for a long time, he's the guy up in the right who earned $5 today. He's told me time and time again, we've had new customers that have come in and requested money, and they said, boy, this person really hit a home run with their business plan. It was everything that, they had everything that we needed right in that business plan. And that's what Keith Gerard is really helpful with, because that's kind of what his job is. And then, secondly, contact a banker and have a discussion. And, have an early on discussion about what your needs are going to be, how you're going to go about it, maybe a preliminary review of the business plan, because they're really a helpful tool to have. And even though we got ties and suits on, we're not really that intimidating. And, pretty easy to talk to. Bruce is a good guy. Dave Harrington's a good guy. So, and Chris Kinney, who's here, is a good guy. So. And then really work with professionals, the accountants, the small business advisory services. Keith Gerard, I already mentioned. And you've got a great opportunity through this program to work with some professionals, because you're going to have a professional investor here next week. You had a professional business plan assistant in Keith Gerard. You've had small business people and entrepreneurs kind of give you their experience, and really it's important to tap into those. So we also want to talk a little bit about, let's say you've got a successful product, a successful business plan, the bank has lent you money, then what does that relationship look like after we've already given you the money? And we really, once again, encourage frequent contact with the lender, especially new businesses. We would really like you to come in and talk to the lender on a quarterly basis, bring your financial statements in, say, listen, this was my projection for cash flow and sales and those type of things, and this is what my actual results were, so, we're off a little bit here, but this is what we're doing, or, you were right on, or you've exceeded your expectations, and it's really important to have a really good open communication with the lender. I talked about quarterly financial statements, and then once your business is stabilized, then we can cut down on the frequency of those meetings. And because you asked a question very early on, what if I can only make half a payment this month, right? And I said, if you communicate with us and work with us, we'll work with you. And that's very, very important. And that's why we encourage this. If there's any blip at all, the first call should be to your banker. And have a good communication, let them know what's up, what your plan is for correcting the blip, and even if the blip is a positive. I mean, the banker wants to hear that you're really doing a good job at your business and he made a good decision to lend you money, because that gives the banker a really good feeling. So does that all make sense?
Can we also just, before, we want to go at 4:30, we want to be able to break up.
Yep.
But could you just explain what a loan looks like? Like, when you get lent money, what do you actually do? What do you sign? How do you know when you're going to pay back how much?
all of that would be contained in what we call a term sheet. And a term sheet is an initial letter from the bank indicating how that loan would look. And it would say, we're going to lend you, the name of the business, this amount of money, this is going to be the interest rate, this is going to be your monthly payment, this is what we're going to require for collateral, the food truck or the kitchen equipment or a house or whatever it might be. Conditions for providing us financial statements would be in there. Bruce, anything else?
Yes, monthly payments and terms, collateral, just an overall understanding of how it's gonna work for both you and the bank.
So that would be the.
Basically an agreement, right?
It's, yeah, and it's
Contract.
sort
It's
of,
a
yeah.
contract.
Well-
For the promissory note, it's just a letter of understanding. If it
Right.
works both of you, do we need to tweak it? Is something not working in that agreement, do we need to tweak it so it fits everyone better than originally planned?
And the reason we do that is that we encourage borrowers to take that and then like review it with their accountant or their business advisor and say, this is what the bank's willing to do. Can we get a little bit of advice as whether this is going to work for me? And we try to structure it that way. But if you've got something in writing from the bank that lays out everything, that gives you a tool to talk to someone that might be able to help you interpret it and see how it's going to fit your business. So if that's all agreeable, then we have what's called a closing. And we get you to sign certain documents that is basically a promise to pay according to the terms of that sheet that we had already sent out. And you would sign that contract to borrow $2,100 from the bank and repay it $100 a month until it's paid back. And
then that kicks in.
that kicks in, right. 'Cause
So if any of you are gonna take out student loans to go to college, you're gonna sign a promissory note. And when I signed them, I didn't really know what that meant, but it's basically, you're just promising to, I mean, I thought, really? They're gonna give me all this money? I just signed this thing? But you're basically writing a contract or signing a contract. So and then you get the funds.
Right.
And you have agreed to the terms of how you're going to pay them back. So it's pretty, it's complicated because there's lots of terms and there's lots of things in that letter of understanding, but
well, some are more complex than others.
But when it comes down to it, you're signing and saying, I agree to this.
And you agree that if you don't pay it back as agreed, then you would personally, if the business can't pay it back, then you would personally, that's where the guarantee comes in. And if all else fails, you agree to surrender whatever collateral that you have put up against the loan.
Thank you so much. Are there any other questions before we break?
I really appreciate the questions. I think they've been great questions. And it helped me to turn a 15-minute presentation into a well over an hour discussion. So I appreciate you taking my comments at the beginning that I'd rather have question and answers and discussion rather than this presentation. So.
Well, thank you.
All right, good luck.